Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, so today, Mena and I would like to talk about should you merge your business. So quite often we get approached by clients where they're thinking about sort of combining their businesses or rolling their smaller business into this larger business, or they're thinking about finding someone that's smaller, that's niche, and bringing them and combining them with their business. So we wanted to talk about, because whether you're the larger business acquiring a smaller or you're a smaller business going into a larger one, the considerations that you want to and the approach that you want to employ are relatively similar. There's some commonality between them. So we want to start the conversation by talking about, what do you consider? And then we will lead into, what's a good process to gradually merge two businesses. So let me start by talking about cultural fit, which I think is arguably the most important thing. It's really, are you going to be happy in this merged firm? And most importantly, will your clients be happy in this merged firm? So do they have the same sort of core values? Do they have the same way of dealing with customers? Do they have the same sort of methodology or approach with approaching business decisions? Do they manage team members in the same way, in terms of making sure that they're respected and looked after, and, all the same things that you have done in your business? You want to make sure that they're either going to be enhanced, maintained through that sort of merging process. And the cultural fit is, I think, probably the thing that comes undone the most. You can make sure you're aligned in terms of product offerings, skill sets, customer bases, all these sorts of things that are very objective, but the subjective stuff in terms of, are you really aligned from a cultural fit perspective is incredibly important.
Yeah, I couldn't agree more. Otherwise, you just end up with disgruntled staff. They're not doing their jobs, and the business will sort of fall apart quicker than it was put together. The next, probably most important thing is also what value does the merger bring to your business? So, are you just merging for growth, just to get more revenue or greater share of the market, or is there actually opportunities for synergies or greater security? You can sort of provide more services to your clients. And look at accounting practices these days. A lot of accounting practices are merging, for example, with mortgage brokering businesses and financial advisors for that very reason, because it's more services that are still quite interrelated that you can provide more value to your clients. And then you also got to consider, if you don't merge, could you lose that opportunity? Could you lose your business to a competitor that offers more sort of products or services? And lastly, what economy of scale are you achieving? Are they bringing in sort of the know-how to do things better than what you currently do in your business? Is there a greater output per staff member because they've got a certain know-how? So all these things you really need to consider before you decide to sort of merge your business.
The third consideration is financial, of course. Like, how does it impact you from a financial perspective? So it goes both ways. So financially, how strong is the business once it's combined? And if the business is acquiring using debt, is that very affordable? Then you've got the transactional consequences financially. So, how are you being paid? Are you being paid in script or cash? Are there any capital gains tax consequences? Can you structure it so that you can make those capital gains tax consequences go away? And then most importantly, once you have done the combination, what does your income profile look like? Because obviously that's going to be probably a combination of salary and then maybe distributions or dividends or so forth. But will that impact your overall income? Because ultimately, for most people, if they're going to combine businesses, they'd love to do it on the hope that their income gets better, not worse. And then finally, what happens if you want to leave one day? So, there's got to be an exit strategy or an exit point at some point. It doesn't have to be, but for most people, that would be the case. So how are you going to crystallize that value? It might be a case of, let's combine these two businesses, grow it, and then sell it on a trade sale basis to someone else in the industry. That could be a good exit strategy. Or if it's not something like that, how are you going to get your money, your equity out of that firm? Thinking about those sorts of things are critical.
You also got to consider control. What kind of control do you have as a result of the merger? Because if you're the smaller business coming into the larger business, more likely or not that you're going to have a smaller say. So, what kind of control do you have over your strategic direction? And this really also sort of ties into the cultural fit. Because if you don't culturally align, your direction, the way that you make business decisions and so forth really get impacted. And as a result, the overall business can really become, worthless. So you really got to consider whether you're, as a result of the merger, becoming an employee because you have a small percentage, or is your value or your expertise really valued?
And finally, excuse my French, but once it all turns to shit, you've got to think about these sorts of things. And I think it's best to make friends with maybe not absolutely worst case scenario, but, a scenario that you wouldn't be hoping for. Because I think if we go in eyes wide open and then something does go awry, at least we go, well, I considered it. I knew that was a potential outcome. Whereas if you don't consider these things from the outset, then you'll look back and kick yourself and go, oh, I wish I thought about that a little bit deeper. So ask yourself, what happens if it doesn't turn out as you hope? What happens if you have a falling out with the other business owners? And look, a lot of this can be dealt with through documentation and agreements and making sure everything is above board and you talk about these sorts of things. But it's something to think about, because ultimately, if you own a relatively small share of a business, its market value isn't really worth anything. No one's going to go and buy 5% of an unlisted business if there's only one shareholder that owns 95% of the business, because that's just, you're in a non-controlling stake in an unlisted business. There's no market for that, right? So whilst there's special value, because to us there's value because we own that 5%, you don't want to get into a dispute situation where you go, let's go and get this market value on this business. And it might not come down to zero, but ultimately, someone that's in a powerful position, say a 95% holder, can maybe force you out of that business with no compensation. So you've got to make friends with, some of these things, which is why, that cultural fit really is super important.
So what should you do if you're considering merging? The first I would probably say is try before you buy. So work within the business for 1 to 3 years to ensure that it sort of aligns with you culturally and along those other factors that we sort of mentioned. Know sort of who you're really getting into bed with. It's quite a personal relationship, obviously business partnerships. So it's really important that you sort of, not take it at face value and really get to know the ins and outs, what sort of ticks off, your potential business partner and so forth.
The next thing that you want to do is get some really good quality taxation advice. You want to make sure that you minimise any tax consequences associated with any merger or acquisition or sale, and whether you can use the small business CGT concessions, which was spoken about before in this podcast, how to structure the ownership, so that depending on what the most likely event is, whether you're going to own that share of the business for a long time and you're just really receiving dividend distributions tax effectively, or whether you expect there's going to be a large capital gain. Either way, you want to start thinking about how the ownership works, and then also, how you deal with the tax consequences associated with distributions and maybe sell down at some point in the future. But you want that sort of tax and structuring advice from your holistic accountant as the sort of second point of call.
And lastly, don't be too gung-ho about it. Do your financial and legal due diligence. Obviously, you need your shareholder or unit holder agreement in place. You need an exit plan should, one of you guys pass away during the tenure of the business. It's really important to have these documents in place, and hopefully you never have to use them because, if you go to court with these documents, yes, they're legally enforceable, but, you never really want to go down the legal path with these things. But it's always good to have there as a safety net.
Okay, so there you go. There's a few factors that you want to consider if you're contemplating merging your business with someone else's or vice versa. And until next week, bye for now.